Good afternoon, everyone, and welcome to this year's webinar put together by HealthCap. So I'm your host for this webinar, and we are going to be looking at three major things. We are going to be looking at accounting, audit, and tax compliance and the issues around it. Welcome once again. While we wait for others to join, I think we just commence. Okay, so I have with me on this webinar experts from various fields who will also be speaking to the subject matter. They are coming with wealth of knowledge from their respective fields. So I have Peter from Pedabo, who will be speaking on audits. We have Adeyemi from Pedabo as well, who will also be speaking on taxation. And we have Udak from all the way from the US, who will be taking us through the compliance, the tax and compliance requirements as it relates to US jurisdiction. This webinar has been put together by HealthCap Africa, so it then makes sense for us to know HealthCap and know what HealthCap stands for. So HealthCap Africa is a venture capital firm with main focus on Africa and African markets. So our core mission is to promote investments that create a healthier world, thereby impacting the lives of over 1.4 billion people living in Africa. Like I said, our fund focuses on Africa, 4 major African markets: Egypt, Nigeria, Kenya, South Africa. For now, of course, we hope to get bigger and expand our market. So far, we've been able to deploy our funds to about 18 companies in health tech and fintech space. So because our fund is a specialist fund, which focuses on two main industry, tech and fintech. And why? Because through tech, we want to impact life, we want to save lives. And also fintech, we also notice that larger percentage of Africans are unbanked. So we then, think of how we want to bring them on board to ensure that they are banked and also move in line with the trend. I mean, what is currently happening in the world. So this is the reason why we go into these two industries respectively, tech, fintech. So through fintech, we make payments, easier and also impacting the over 1.4 billion people across Africa. So one good thing about our portfolio companies is that there is a gender balance. Currently, we have about 50% women in management, constituting management team of our portfolio companies, while we have been able to create about 56.7% of our jobs for women. So which means we are speaking gender balance. So so far we've been able to directly created 1,000 plus job and 12,000 indirect job through our portfolio companies. Many of our portfolio companies have gone ahead to raise follow-on capital from notable DFI that we know, like Nigerian Bank of Industry, Newton Partners, Horizon Venture, and even Y Combinator. So, which speaks about the companies in our portfolio, pipeline. So, moving on about your host, I'm the host for this webinar, and of course, just brief introduction of myself. So, my name is Adede Jilamwe. I'm a seasoned finance and accounts professional with extensive experience across finance and accounts departments. So I've been able to grow through cadre, through job functions within finance and account department, which has allowed me, or which has equipped me with end-to-end knowledge of how finance and accounts department runs. So I'm a good leader, so I enjoy, leading cross-functional teams, mentoring finance professionals, and collaborating with stakeholders in order to come about financial strategies that help companies safeguard their financial assets and, of course, improving and increasing stakeholders' wealth. So far, I've been recognized for notable personal achievements in my career so far, all centered around identifying deficiency in accounts, processes, and procedures, and improving on them. Here at HealthCap, I'm the lead finance and portfolio. Diving into the webinar straight. So the webinar, like I said, focuses on three main aspects, which is financial reporting and management, audit, and taxation. So we'll be relating these three aspects to startups and how startups can leverage these three things to improve or to accelerate their growth, because you really need these three things. Financial management. Talking of financial management, we'll be speaking to management accounts, how you prepare your management accounts, the type of accounting software that you adopt as a startup, trend analysis, and how you present your management report to stakeholders. Speaking of management accounts, as a startup, you ensure that every month you get your three financial statements prepared, and you get them. Okay, you get your three statements, prepared every month to ensure that your key stakeholders have access to what is happening in the company. Statement of profit or loss. This typically just shows us how much profit you have made as a company. Is there a loss? Is there a profit? How much? So this is basically it. So you need to ensure that every month you prepare your statement of profit or loss to ensure that you capture your operating activity. Statement of cash flow. Also, as a startup company, because you don't have access to huge cash flow yet, it then makes sense for you to ensure that you properly track the little one that you have, which is why you need to always track your statement of cash flow. You want to know your runway, you want to know your burn rate, you want to know how long it takes you to generate cash and how long it takes you to to spend it. So you need to ensure that you get your cash flow, statement of cash flow prepared every month. This typically shows how you have generated your cash for a particular month or for a particular period, and how you have spent it. So it is being broken down into three buckets. You have your operating activities, you have your investing activities, and you have your financing activities. So speaking about the accounting software, of course, if you are to prepare your management account, you need financial data. So it then takes us to how you keep your financial data. How do you keep your financial data? So is it through the oldest paper and pencil, whereby you just write everything down in the journal, or you go by Excel, whereby you keep your financial data in Excel, or you go for accounting software? The straightforward and shortest answer is accounting software. And why? Because accounting software ensures security and Yeah, security of your financial data. So it's because Excel can crash, but accounting software, has that security. Once it is provided, once it is set up accurately, so you have that security of information. So in any year, in any period of time, you can go back as far back as when you started using it to access your financial data. So for the sake of security, you actually need accounting software. Yes, it comes at a cost, but when you balance it against the benefits, you will see that the benefit outweighs the cost. So it's always good to go for accounting software, and it's always good to go for it as early as you're starting your operation, because migrating your data when the operation is becoming bigger, is always coming with a lot of nuances, because you migrate balances, you run your software alongside other ways of keeping your record concurrently for the period of migration. So it's always good to start as early as you start operation. So you have a few of them that you can pick from. You have ZoboBook, you have QuickBooks, you have Microsoft Dynamics. So these are some of the packages that small startup can actually leverage. So we have bigger ones like SAP. We have the likes of SAP and Sage and the likes. So another thing is trend analysis. Yes, you have kept your record, you have used it to prepare your management account. So what else do you do with it? You do what we call trend analysis. Trend analysis is very, very important, especially for startup. And why is it important? Because you are just starting your operation, your revenue is not enormous yet. So you need to track how you are faring every month, especially against how you have done in the past period. So you want to know the trend. So in a period where you experience a surge, what has brought about the surge? Because you need to document, you need to know everything, not document, you need to know everything as it relates to market where you play. Because you need to know, your market share in a period whereby you made more revenue. Is it due to your market share? Is it due to seasonality? Is it true? You need all those analysis, and you can only be inquisitive about all of these things when you have trend analysis. So meaning when you compare your financial information month on month, so you compare it with months before. So that shows you what has happened and what the underlying operating activity is for your numbers. So that's just about trend analysis. What it does for you, like I said, it helps you to identify areas for improvement as early as they are happening. For example, last month you made revenue of $100,000, and this month you are making $50,000. What is causing the downward review? You need to know, and this is what trend analysis is all about. It helps you to identify areas for improvement as early as they happen. And of course, another trend analysis you can also do is to benchmark your financial performance against some of the industry leaders if you are not a leader yet. So you benchmark it, and that will also trigger questions. What are they doing differently that you need to also do? What are the other opportunities that abound in the market that are yet untapped? So those are the questions, that are the strategic questions that your trend analysis triggers. So how do you then present your financial report? Yes, as a startup company, not only internally, you also have reporting line to your external stakeholders, investors, banks, and whoever that has provided you funds, capital. So you have, to supply them with your financial information. These are guys that are very busy. You then need to ensure that your information, the presentation of your financial information is very concise. You give them what they want to say at a glance. So you present it in a way that you capture all your key metrics, your revenue month on month. You present it with graph, how it has, how you have performed in few months. So they see it, how your revenue has moved, your gross profit, your bottom line. So all those key metrics, you just capture it, a kind of, summary overview of your financial performance, because they don't have time. Then we have continuous learning. As a startup, not only the accounting or finance person, even the whole company as a whole, from the CEO or from the founder to the last person. Everybody at that period needs to learn. You need to learn about the operation, you need to learn about the markets, and for accountants, most importantly, they need to learn how these two things translate into the financial figure that they are capturing every month. So that is why continuous learning is very, very important. For accountants, of course, we have ICANN and some other professional bodies providing continuous professional development courses. So you encourage them to take development courses, other professional courses online and offline to ensure that they improve themselves. Because all of these things, human being is the greatest asset that any company can have, and most importantly, a startup. Because at that particular point in time, you need knowledge to scale through the market. So you can't play with continuous learning. So moving on to audits. Of course, the question that comes to mind when we are talking about audit for a startup is, does a startup company really need audits at that early stage? The straightforward answer is yes, you need audits. And why? We get there. So if you then need audits, of course, how do you then find an audit firm? How do you define deadlines? What are the paperwork that you need to submit to your audit and every other thing as it relates to audits? So why audits as a startup? Why do you need audits? Straightforward answer is that you need audits to give credibility to your financial information. Because when you have prepared your financial information, you need an independent third party to look into it and certify it. And why do you need the auditor's signature? Why do you need that credibility? Because at that stage, you are still raising funds. You need investors, be it through equity, be it through loan or debt. So you need money. That's it. So, and for investors to disburse money to you, they need a level of comfort. They need a certain level of comfort to be sure that the company where they are investing is actually, profitable, it aligns with their goal in terms of impact and what they want their portfolio company to achieve. So they want to be sure of this, and they want to be sure that your financial information is accurate, is as accurate as possible, and of course, present fairly what it's meant to present. So that is why you need audit. It is only audit that gives that comfort to the investors. So how do you then find an audit firm? So when you are deciding to choose an audit firm, you have a few things to consider as a startup company. Of course, your operation is not big yet, so you need to consider your revenue, how much you are generating, how much money you are making as bottom line. So you need to consider this, because you don't want to bear, you don't even want a situation whereby the audit fee is the major cost or major expense in your book. So you need to look at the level of your operation, the revenue. You need to look at the reputation. In as much as you are trying to get an audit firm that comes at a lower cost, you also need to juxtapose it with the reputation of the audit firm. How reputable are they in terms of of their service, the industry expertise? What is the level of their expertise? When we are talking about the industry where you operate, because we have some special specialist special industry, let me say, or specialized industry, like fintech, for example, like edtech as well. If you really don't understand the industry, as it were, you may find it very difficult to to audit the company. So you need to check their industry expertise and the level, the quality of their service, all of these things together. And of course, if you are a startup with a goal to expand to other geographical area, other shore, like other countries, you need to check their geographical coverage. So moving on, so we basically have two types of audits. We have interim audits, and then we have final audits. As a startup company, do you need interim audits? The answer to that lies in the industry where you operate. And why did I say so? because there are some industry whereby you need to file your financial statement as early as 31st of March. They are heavily regulated. And one of them is fintech. Fintech is heavily regulated by CBN, which requires every operator in that industry to file their financial statements by 31st of March every year. If that's the case, it then means that you only have 3 months after year end to finish your audit. And sometimes audit drags, right? Because of back and forth with auditors. It happens. It's legal. There's nothing bad in it. So it then means that you may actually need interim auditing sometimes. So whereby they need to just look at your books, probably January to September, 9 months ahead. When they look at that, they then have to look at just 3 months when they are coming for final audit. So that is what interim audit does. So they look at few months down the line, probably January to September or January to October. So they look at that within the period of November and December. Once they are done with that, they are just incorporating the remaining 3 months or 2 months into the final audit, and they just finalize it. And this will ensure that you are able to meet with the filing deadline of your regulator. So for the paperwork to be submitted for an audit, so the major one, we are just going to be discussing the major ones, which of course you need your trial balance. And to get your trial balance, it will take us back to where we started from. You need to keep your record accurately. So you need to keep your financial record, because those are the information that we sum together to form your trial balance. So you need to supply trial balance to your auditor. So they call it planning TB, planning trial balance. So when you give them that, in some instances, they ask for a management account. And like we discussed earlier, and that is why you need your monthly management account to be intact. So you give them your management account in some instances, like I said. Then you also have supporting schedules. Supporting schedules for the likes of fixed assets, your receivables, what makes up of that your receivable that you are carrying in your trial balance, that one figure. We need the breakdown. Your payables and some other major items like that, you need supporting schedules. And of course, after they take their sampling, so they will also come for fieldwork, whereby they will need some supporting documents like your invoices, your contract with your major customers, also your contract, your agreement with your major vendors. So you need to always keep this intact, and that is why you need data. You need strong database to always keep all of this financial information. So another question is, should a startup company go for a Big Four, or at what point does a company go for Big Four? So you need to always decide this, so that you don't just waste resources unnecessarily. Believe me, if your operation is not that big, we actually have some smaller companies, so some smaller audit firms, not as big as Big Four, but have that credibility as very close to Big Four. Yes, the level of the thoroughness of the work that they will do, and the rigor and everything. So it's as if it's like that of Big Four as well. So you need to decide all of these things before you go for your audit firm. And why do you need Big Four, or why don't you need Big Four if you must take that decision? Like I said earlier, you look at your operation. At what stage are you as a company? Are you just a startup, or you are big already? I mean, you are currently at a stage whereby you have reached your growth trajectory is there already. I mean, you have reached the final growth stage. So not when you are just coming up as a startup. So you need to decide all of this, because Big Four also come at a big cost. And of course, imagine your revenue is about $100,000, and then you are paying Big Four about $5,000 to audit that. So you may actually want to go for a fewer or a lesser audit firm, so, or a smaller audit firm. So we have in our vendor stack, we have a few of them, and good enough, we have representative from Pedable auditors. So we will also be speaking to some of these things when they have the floor. So we have the big four, we have the ones that we categorize into tier 2. We have, as it relates to tax, we have Anderson Global. Audit, we have Creston Pedable auditors. For tier 3, we have Maple Consulting as it relates to tax, and we have Take and Co. And of course, we have some other co around you that you can also engage. So for the last, the third category, the third segment of the presentation, which is taxation and regulatory compliance. As a startup, you don't want to compound your headache. And what do I mean by that? Government, or let me say compliance, is a necessary evil that you must actually comply with. Yes, nobody actually likes all the filing headaches, the remittances, and all of that, but it's necessary because it's you can't run away from it. And to continue in operation, you actually need to comply. They may not come today, but believe me, they are coming. It may now be when you have grown and your operation is already big, they will now open your book up to the very first year you started operation. So, and you can imagine you've had turnover, some of your employees have left, some of the people that actually understand or that know the story of the financial information. It then means that it will become very difficult for your standing or current accountant or current finance and account professionals to go back to those years to unravel what happened in those years. So you don't want so, and that is why you need to always address compliance and regulatory issue as they are occurring, because you don't want a situation whereby they come at a later day to come and steal your office or to come and paste a sticker on your door for non-compliance. So we'll be looking at, as it relates to Nigeria, we'll be looking at some of the taxes administered by FRS. FRS stands for Federal Inland Revenue Service, and that is the body that administers taxes for federal government. So we have states, which, of course, in the case of Lagos, we have Lagos Internal Revenue Service. In any state where you operate, you will also have that state Board of Internal Revenue. So that state's Internal Revenue Service. So we'll also be looking at some of the taxes being administered by some of these authorities. We'll be looking at filing and, of course, some of the deduction from payroll and some other deductions. So, and also we'll be looking at statutory, regulatory, and compliance issue as it relates to the United States of America, of course, which UDAC will be handling for us. So for Nigeria, so like I said, we have FRS who administer taxes for federal government, and the major taxes they administer is, of course, CIT, corporate income tax, value-added tax, and in some instances, withholding tax that is due to the federal government. So they administer these three major taxes. They have other ones like stamp duty and some other ones, which you need to be aware of. But as a startup, you can run away from these three. They apply to every company, regardless of any state that any company is. So company income tax, currently, the companies are grouped into three. So we have small, we have medium, and then we have large. For small companies, so they are zero rated. So meaning that on their profit, they are not paying tax. So their own tax rate is zero. They are exempt from paying tax. And why? Because they are small. Their revenue is still between 0 and 100 million naira. So if you are making that revenue, so it is assumed that you are still a small firm. That okay, when you make profit, don't pay CIT on it, but you pay VAT if your service or good is VATable. You pay VAT. You pay with withholding tax. But CIT, when you have completed your account, you have completed your audit, and you realize that your revenue is within 100 million naira. Government is saying that don't pay us as CIT. For medium company, it is from 100 million naira to 500 million naira, right? So which government is saying that, okay, because your revenue is between 100 million and 500 million naira, you are a medium company, you are still not big yet, but just pay us 20% of your profit. But for large companies, they are the companies generating 500 million naira and above, which is at 30% of their profits before tax. So value-added tax in Nigeria is currently at 7.5% of your invoice amount. So which means when you are invoicing your customer, if your service or good is valuable, you are adding 7.5% to it, which will be remitted to the government. Then you have your withholding tax, which ranges from 5% and 10%, as the case may be. So for all companies, not only startup, we have statutory filing for CAC. So every year, CAC is saying that as a registered company, you need to file your financials with us. So if you are just starting up your company newly, so you have an election to pick from either 6 months after your first financial statement or 18 months after you start operation. So you can choose any one. So, but if you prepare your accounts up to December, so you can just pick that of 6 months, which means you need to file your financial statement with CAC within the next 6 months. Which means for this year now, we still have between March and June to file our financial statement with CAC. For pension certificate, this is very, very important, especially for any company that aims to, get bigger and transact with government parastatals. Government parastatals, as part of document that they ask for when they are asking you to bid for project or for any service that you have to provide for them, one of the documents they always ask for is PENCOM, because government want to enforce compliance with some of the tax and compliance laws and rules. They are, indirectly enforcing those laws through their commission, through their, their bodies. So, and that is why they ask for all of these documents. They will ask for your tax clearance certificate, and that is why you also need to comply with all taxes. Because when you are bidding, and in some instances, when you are even bidding from a large, corporation, I mean private companies, they also request for all of these documents. So they want to know that you comply with all taxes, all tax laws, sorry. So pension certificate is one of it. So which of course you process after you have complied with remittance of pensions for your employees. It's just 8% of 8% of basic housing and transport from your employee, and then 10% from you as employer. That's just it. You remit it, and you ensure that you remit it before 10th of of the following month. So, and of course, every year you process pension certificate. Another deduction is ITF. As a new company, yes, of course, you have burdens already, you have costs. However, as it relates to your employees, just ensure that you take all of this deduction into consideration, because, like I said, you never can tell. You may just win, you may just be invited for a bid for a business that is worth billions of naira, and you can't just you don't want to find yourself missing that opportunity just because of pension certificate, just because of ITF certificate. And that is why you need to take all of those things very seriously at the very early stage that you're starting your company. You don't wait till you become bigger before you start implementing all of these things. So you have ITF that is also deducted, that is also remitted for your employees. So of course we have transfer pricing. Transfer pricing is just basically how related party charge prices amongst themselves. So because government want to ensure that there is no profit shifting. So if you are a company that has entity in Nigeria, you have another one in the UK, they want to ensure that the profit that is due to Nigeria is retained in Nigeria. It is not being taken out of the shore of Nigeria. So, and that is what transfer pricing is all about. They want to ensure that every time that you transact between your company in Nigeria and your company in UK, you are pricing it at what we call arm's length. So the price at which you will have priced that particular service or good if you were to transact with a third party. That's just basically what transfer pricing is all about. So this is just a list of what we need for registration with FRS and CAC. Is just pretty much straightforward. You have your name of the company, your registered address where you want to be carrying out your business operation. You have your business address, nature of business, what you do, what you have set out to be doing as a company, the date of commencement of business, and all of this. So of course, if you go to their portal, you will also see this list there. So you just go through the list, ensure that you have all of these documents intact to ensure that you have a seamless registration with FRS and also CAC. CAC stands for Corporate Affairs Commission. So this slide just kind of shows us the deadline for some of these tax remittance and filing. So it's very, very important because what the authority does in many instances is that when you have defaulted in remitting your tax, they don't come immediately, right? But they start charging penalty and interest on penalty immediately from the day after your default. So, and that is why you can't default. So that is why you need to be on top of your game when it comes to the deadline for each of your filing. We have payee. Payee is pay as you earn, which you deduct from your employee. So government is saying that remit this before 10th of every month. So which means for February, after paying my employee, I need to have, I need to ensure that I remit the payee between now 6th and 10th of March. And that is for the one that is relating to February. It is on preceding months basis. So for pension, you ensure that you remit pension within the 7 days after salary payment. So when you pay salary, you deduct your pension and you remit it to the respective pension administrator. So we have payee filing. Payee filing is different from remittance. Remittance, in many instances, when it comes to taxation and regulatory compliance, remittance is different from filing. You can remit, and then you are still penalized. Why? You have paid. Why are you still being penalized? Because you'll be penalized because filing is more important than remittance. Because governments collects bulk of money, collects, the stream of revenue, is very enormous. And government cannot be tracking one by one who has paid, who has not paid. So the only way where government gets to know who has paid is through filing. After you have remitted, you must file. Filing is what is notifying government that, look, government, I have paid certain amount in form of payee. Government have paid certain amount in form of VAT. And that is why remittance is very, very important. There are even some instances whereby you don't pay tax, but you must still file. For example, if you are a small company, like I said earlier, and you are exempt from paying CIT, does it mean that you just fold your hand and just, since I'm not paying, I made revenue of 99 million, I'm not paying tax, then let me just move on with my life. Then that is when you will now pay more than what you should have paid, because you must file. So you file your financial statement with government that, look, government, in this year, I've made something less than 100 million. And according to your law, you said I should not pay anything. But because I need to show you how much I have made, and reason why I have not paid tax, and that is why I'm filing. And that is what filing is all about. And that is why we have payee remittance and we have payee filing. Deadline for payee filing is 31st of January every year, where you file for all your staff. So we have VAT, which is due 21st of every month. We have withholding tax that you have withheld from the invoices of your vendor, which you must remit in their name to the government. This is also due 21st of every March. So we have ITF, which is also that this one is annual. It's annual. So you ensure that you file it 31st of every March, and then you have company income tax, which is CIT, which the filing due date is within the 6 months after the end of a company financial year. So I've closed my book for 2024 in December, right? I need to file CIT between now and June 2025. And don't forget, between that period, I must, or let me say, I have audits. And that is why we spoke about interim audit the other time. So you ensure that you manage all of these things in order to ensure that you comply with the filing date. So, like I said, I have co-panelists on this webinar who will also be chipping in their explanation, their opinions and views on this subject matter. And I would like to bring on board the first person who will be speaking to us within the next 5 to 10 minutes on audit and why you need audit as a startup. So it's just to elaborate on what we have discussed. And afterward, we are going to be having a question and answer after I have the three of them, speak to the subject matter. So Peter, if you can hear me, so you have the stage to just, discuss with us why we need audits. Thank you.
Thank you very much, Adedeji, for a very detailed presentation. My name is Peter Asema. I'm a partner in Creston Pedabo. I have just a few minutes to quickly highlight a bit of some audit area. So basically, I'll just be adding to what Adedeji had said. I know he said a lot about accounting, audit, and reporting. Generally, as an auditor, what we usually encourage clients to do is to ensure their accounts are audited regularly. And over the years, what we've realized is there are so many people or entrepreneurs that are crazy and that are passionate about carrying out business and providing value and service to the point where they neglect the accounting part and the audit part. What you find out is over the years, they've carried on business and they've provided value and they are passionate about what they do. They're expanding very fast, even faster than they themselves had envisaged. And what happens is they find out that they're lagging behind in terms of their reporting, accounting, and audit. And suddenly a taxman, they receive a tax letter asking them to come and pay so much tax. And they're like, how come I can't pay? But that's usually the scenario you find. And that's why we usually encourage everyone starting out or who is in business to ensure that right from the start, you keep proper records. Even if it's an exercise book, an Excel sheet, but keep proper records so that at the end of the day, it's not just your bank statements that people rely on. And the benefit of keeping records is it's several reasons. First, for anybody to want to invest in your business, the first thing they'll be expecting is that you should be able to probably give reasons how you've run the business over the years, how profitable the business has been. And the only way you can show all this is through your financial records. But not just that by having an audit is basically having an external professional coming to certify that those numbers or those profits that you've disclosed are real, that they are not just numbers that you are presenting to them. These are numbers that a professional has looked at and they are certified that yes, your profits are actually real profits. So basically, carrying out an audit basically enhances the credibility of your financial reports. it enhances the credibility of the company. That's why you find out that with investors, with bankers, everybody will request, go bring an audited financial. That way, they can be sure that it's not just the company that brings numbers together, but somebody external has reviewed and confirmed that these numbers are actually real. Then the other value of carrying out an audit is the fact that by carrying out an audit, what you will be able to do is ensure compliance. So like Adedeji has talked about in terms of deadline for filing your returns, by carrying out the audit, you are able to meet that deadline, and those are the financials that are accepted by the tax authority. The other value that you get from carrying out a statutory audit is that you get a professional to come review your numbers, and they can disclose if you have errors. You find out that a lot of people carry out business and have a sense that this is how it should be done or presented. By carrying out an audit, someone comes to look at what you have done and tell you, no, this is how to do it in line with the standards, in line with the regulations. That way, you can present a financial that is not just numbers, speaking to the numbers, but also in line with the regulation in terms of compliance. You can ensure that whoever the statutory auditor has reviewed those numbers. If there are errors, they will detect it. I've also seen scenarios where it was during the audit that the owners of the businesses, the MD CEOs, realized that someone has been stealing from them in terms of fraud. It was during the audit that the auditors pointed out that something does not add up. There's obviously signs that someone or something is amiss. And by the time a detailed review is done, they realize that someone in the system, if he's the accountant or the head of sales or somebody, has been doing something that and been manipulating the numbers, and those numbers are not real. So an audit also helps you discover if there's fraud in your business that you may not be aware, because all you are seeing is that you are seeing a growing business but does not translate to cash. An audit could help you discover such discrepancies, which is why we also always advise that you carry out an audit. An audit equally can also help you improve your process, your system, the way you do things. You find out that I've met a client that approval was done on WhatsApp. You just see that the people on ground will say, oh, madam, we need to buy this, and the person just gives approval on WhatsApp. The person just gives a verbal approval. It's when an audit comes around that they will be asking for proof of those transactions, that you now find out that, I really need to put documentation in place, because if not, what are the chances that approvals are not given, transactions are carried out, and the company loses money? So an auditor will come in and tell you that no, you cannot give WhatsApp approval. And you're like, that's what's convenient. Say no. There are ways where you can get systems, you can do emails where people can actually see those emails and those are your approval, or you have more than one person approving a transaction. I've gone to a company where you have only one person in finance, is initiating, is authorizing, because the MD or CEO trusts the person fully. It was the auditors that, as auditors, we are the ones saying, don't do that. There's a risk that something could go wrong. So you find out that as business owners, a lot of business owners are solely focused on the business and neglect the control aspect of the business. So an auditor most times will make you see that it's important that while you are focusing on growing the business, you also focus on compliance, controls, and putting adequate controls and checkmates any kind of occurrences of fraud. Then also, if you're a business that carries out regular audits, when you get an investor or someone who is ready to invest in a business and he asks for your financial statements, and you're able to provide audited financial statement immediately, it sort of builds confidence in your business. The person knows that this is a serious business, and he also looks at the quality of who your auditors are. So it's important that without compromising or trying to be pretty expensive, that you look for an auditor that is credible and you don't just go for an. So you can, for instance, someone would ask, how do I know the auditor is credible? Anybody that is auditing your account that is not asking the right questions, like asking you, why have you spent, what are the receipts, what are the support documents, checking your PP, this. But when you have an auditor that just comes in, you send him whatever, and in 2 days or 3 days, he sends you back a financial without asking any state questions, without stressing you, I can assure you that that person is doing nothing for you. But when you see that you have an auditor that is asking you questions, then you can be sure that the person is doing a detailed job. That's what I would like to say. Then finally, I would say having an auditor also helps you to plan strategically, because when you know those numbers have been verified, they are correct, then you can base your budget or projections on correct numbers, even when you would have to project in terms of, okay, how well are we going to do? What's going to happen? Instead of working with management accounts that may have issues, errors, an audit will help you at least have confidence in your number, and you'll be proud that as a company, this is what we've done. I've had a third party look through it, and I can tell anybody that I'm sure of those numbers. So for me, I would say carrying out an audit is very, very important. Yes, it comes with a cost, but the value you get out of it is more important than the cost. Thank you. I think because of time, I would stop here. Thank you very much.
Thank you so much, Peter. That was an insightful one, a very, very concise but detailed. It captures every aspect that needs to, to be touched. So thank you so much. I think the other person we'll be bringing on board is Adeyemi, also from Federal Law, to be speaking to us on taxation, basically, or let me say, with major focus on the major changes with these proposed tax bills, Nigerian tax bills. So we want to know ahead before they are even passed into law. So what are the changes that you think businesses should be aware of and plan ahead of before the bills are passed into law? Thank you, Adeyemi.
Okay, thank you for having me. Good afternoon, everyone. My name is Adeyemi Falabi Smith. I'm a senior manager in tax department from Creston Pedabo. So to quickly go into a quick conversation, the Nigerian government has introduced, we're currently calling it Nigerian Tax Bill, right, which is meant to consolidate about 21 tax provisions by repealing those other ones and then replacing it with a more comprehensive tax law that governs a lot of things. How does it affect startup as companies? How does it affect them? Some of these provisions have been tailored in such a way that it makes small businesses or startup, it makes cash flow easy. It helps them also be able to plan expansion into the future without having to unnecessarily eat them with taxes now, because government is also projecting that these businesses will grow. Now, some of these key highlights stems from corporate taxes. Corporate taxes, for instance, under company income tax. Before now, under the prior provision, right, there's a provision, section 40 and 105 in Company Income Tax Act, right, that specifies threshold and categorization into companies, right, which means you can either be a small company, you can be a medium-sized company, means you earn 25 million naira below as revenue, right? Being a medium-sized company means you earn between 25 million and 100 million as revenue. And then every other person that earns 100 million and above is called a large company. Now, the incentive that has been drafted in here is to say that we understand that companies that are trying to find their feet or new companies might have turbulent early days. So an adjustment is being made to the revenue threshold for you to be called a small company. So by the time this bill becomes an act, it simply means that you would now be a small company if you earn 50 million revenue and below. And what that means for you as an entity is that you will no longer be paying taxes. your taxes, your income tax will now be based at 0%. And of course, it also excludes you from the provisions of the VAT Act, especially as also on obligations of VAT, most especially when you're not doing any of the activities as exempted by the first schedule, activities like medical service, basic food items, medical or pharmaceutical products, and things like that. So what that has done is that it has increased the threshold so that a lot of companies that are still having 50 million in revenue or below are still small companies. And so with that, they will not be bothered with how to pay taxes, how to comply with VAT and all of that. And then there's now the categorization. There's going to be a categorization of, if you're not a small company, it means you are any other company, right? And without any other company, before now, tax was paid 20% if you're medium, 30% if you're large. But what is happening now is that that provision has now said that for 2025 year of assessment, which is going to be June this year, the CIT rate will now be at 27.5%, right? And then from 2026 way forward, it will now be reduced to 25% instead of the 30% that we used to have. Another key benefit you can take away from this provision is the fact that before now, if you incur an expense, especially pre-operational expense that you've incurred in your business, entitled to this provision, it will not be admissible for tax. But this act has also introduced the fact that, look, we understand that new businesses will need to incur a lot of costs, right? Which means that pre-operational expenses would now be admissible for tax as long as it's been incurred up until 6 years, before you commence business. It means that you will now be eligible to claim all of those provisions. Now, late last year, there was a regulation that was issued by the Federal Ministry of Finance and gazetted by the Federal Republic, right? And it talks about withholding tax obligations, right? That provision is called withholding tax regulation. It now covers everything about withholding taxes. And it has also given some form of waiver for small companies to be overburdened by them having obligation to deduct taxes. What that law is now saying is that if you're a small company, you necessarily don't have to bother yourself with deducting withholding tax from companies. As long as you have been able to get invoices from vendor under two conditions. One, the vendor must have a TIN number, right? And second option is that the invoice must be less than 2 million naira on that transaction, so that you as a small company would not be eligible, you would not be eligible or held liable to start having withholding taxes to be deducted. Before now, you would have quite a lot of layer of taxes, NSI, NITDA levy, police trust fund, and a lot of those other funds. What has happened is that it is now all being consolidated into what we call development levy, which is going to be subjected on assessable profit at 4%, right? So it is that 4% is going to be applicable for 3 years, for 2 years, which is going to be 2025 and 2026 year of assessment, after which it becomes 3% from 2027 to 2029, before it now moves to 2% from 2030 upward. Now, speaking to VAT as it affects small companies, there's a provision in the VAT law currently that talks about exemption of small companies from VAT. It simply means by the time this law is now being implemented, the Nigerian Tax Bill, the moment you have invoices less than 25 million or less than 50 million, you will no longer have obligation to charge VAT on your transactions. So it will make your service or your goods a bit cheaper, rather than having to add additional 7.5% of it into that provision. And additionally, on that VAT law talked about increasing the threshold for the VAT to go to 10% in 2025, right? And then 12% for 2026 to 12.5% from 2026 to 2029. And from 2030, it's going to be 15%. Now, what all of these provisions do is that it finds a way to take off burdens of small companies such that at every point in time, you have enough funds to be able to manage your business. You have enough funds to be able to plow back for the purpose of future expansion. The tax authority or the Nigerian government is now seeking to see that they help businesses grow. And you would agree with me that part of the things that do not allow businesses grow are a lot of obligations, either by way of taxes, some form of other levies to be paid here and there. At the end of the day, you'll lean on cash And what that means is that you might not be able to augment your working capital. And so all of these provisions are actually being put there so that you could have some form of soft landing, right? And at the end of the day, it simply means that until you gain your feet, of course, you would agree with me, once a company starts handling above 50 million, there's a very high level of chance that you will now have proper structures, you have implementation, you'd have department that are overseeing certain things, because at that point, you're now burdened with compliance for taxes. And when you do not make this compliance possible, or when you do not adhere to this compliance, by the time you cross that threshold of being a smart company, it simply means you will now start having obligations to pay the taxes if the tax authorities are the ones who found out. You now have obligation to pay those taxes, pay the penalty of 10%, and then pay the interest, which is currently sitting around 31.75 has been accessible by government. So imagine you having an obligation for 10 million, right? And you did not pay that 10 million as at the due time. What it means is that you now had a penalty of 10% and also 31.75%, which means you'll be paying an additional about 41%, right? Driving to about 4 billion in that 10 million. And that is not the end of it. And that is why compliance is a very key portion. As a startup company, you actually need the guidance of tax consultants and professionals to help you pilot your affairs. And the reason is because that 31.75, that is the current interest being accessible, being applied by tax authorities. The moment it accrues for about 3 years, say for instance, the transaction belongs to 2023, and then government does not come until 2028. It simply means you pay 31% of that tax liability per year. It will become compounded across all of those years. And then at the end of the day, you find out that your interest is actually huge than it should be. So which speaks to the fact that you need to have a lot of financial planning in place, right? And also try to put in some structures within your entity so that this compliance can be done seamlessly, and then you avoid the imposition of all these ridiculous and huge penalties and interest. Because of time, I would like to stop with that for now. And when we get to questions and answers, we can take more questions and answers. Thank you.
Oh, wow. Thank you so much, Adeyemi, for that, great addition. So thank you so much. So like you said, every other thing that needs to be said, we hope that question and answer will touch on that. So I would like the top person that will be speaking to us will be Udak. Udak Ekpe, all the way from US, like I said, she'll be speaking to us on the tax and regulatory compliance that any startup company in the US needs to be aware of. Because like we said, compliance is a form of nuance that you must take out if you must succeed, sorry, as a company. So in order to achieve that success, so you need to ensure that you comply accurately with all the tax and regulatory compliance. Thank you so much for joining UBAC. So you have the floor now. You have the floor now.
Hello, hi, can you hear me? Okay, you're muted, but I assume that you can hear me.
Yes, we can hear you now.
I can hear you.
Okay,
Thank you.
Okay, that's fine. Hi, thank you so much for the introduction, and I'm really glad to be here. I have learned a lot from just listening to the other speakers, and I'm just going to be talking, as Mr. Adedeji has said, on compliance for US companies and basically how to figure out setting up a legal entity in the US and the compliance that you need to be aware of. Of course, I know that this webinar is targeted towards startups. So if you haven't already raised funds, you're probably looking to raise funds or in the process of speaking to investors, trying to find investors to fund your startup. And one of the things that investors tend to require is for a company to be registered in the US, to be able to invest in those companies, especially if the investors are international investors. And with registering in the US, most investors also tend to prefer that the company be registered in Delaware. Now, registering the company is the most straightforward part of the process, and most people are not usually, most founders are usually not ready for the compliance that tends to come with maintaining that company. So I'm just going to be talking about some of the things that you need to be aware of, because as we've heard from the other speakers, these things are important. These things cannot be avoided. And when you don't comply with them, there are also penalties that are applicable. And you don't want to be on the wrong side of the law. You always want to be on the right side of the law. So I'm just going to be talking through some of those things. So first of all, in terms of even when you want to start registering the company, some of the things to think about is answering the first question of why do you want to have a company registered in the US? And there are several reasons why you may want to do that. Like I said, maybe you're trying to raise funds from investors. Maybe you run a business and you're beginning to have customers from different countries. You want to be able to receive payments from those customers, and US is one of the most recognized financial systems in the world. So it just makes sense that you want to have a company registered there to be able to access those payments easier. Maybe even just for immigration reasons, you think that if you register a company, it's easier for you to immigrate when you get to that point. Those are all valid reasons to register a company, but you now need to be sure that you are registering the right kind of company for your business needs, and you know the compliance that would be required of that company when the time comes. So there are different company structures when you want to register. There's two major company structures, if I can say that. So there's the corporations. Corporations are for people who want to be able to issue shares in the company. So if you're a startup that is raising funds or will raise funds from investors, you want to register as a corporation so that you have shares in the company that you can then issue to your investors. But now, if you're a business that, as I said, has just expanded, has grown organically, you're not looking for any external funds, maybe you're just a solo founder, or maybe a partnership, and you just want to register, you're not really thinking about having external people into the business, then you can register as an LLC. An LLC is a limited liability company. And when you register as this, the structure is a lot easier. It's a lot easier, a lot straightforward to manage, and also less expensive compared to a corporation. So these are some of the things that you need to think about before you have a company opened. Now, after you've gone through the process of registering a company and you want to maintain it, now what are the things you need to be aware of? So for compliance, there's the federal compliance on the federal level, and then there's compliance on the state level. So I'm going to speak on the federal level first, and then I will speak on the state compliance after that. So for the federal level, the first thing, the most important thing is the federal tax returns. So your federal tax returns are required to be filed by every company that is registered in the US, regardless of whether you are making income, whether you started using the company. We have founders sometimes say things like, "Oh, I've just registered the company. I haven't even started using it yet. Do I need to file this?" And the answer to that question is yes, you do. As far as the company is in existence, then you need to start filing your tax returns, even if you're not even making any money yet, even if you're not making any income, even if you don't even have any taxes to pay yet. And this is very important because I was listening to Mr. Dedeji speak earlier, and he said something like, the government will not come after you when you haven't paid the taxes, right? They wouldn't come look for you immediately. But maybe years down the line, when you need to do something, when your company is a lot bigger and the stakes are higher, then they come knocking at the door. And you don't want to be in a position where you now have way more to pay in penalties or interest. So it's always better, or even if you don't even have or even if you don't have taxes to pay now, it's better that you file the returns so that when the taxes are then due, you don't have to pay an exorbitant amount in penalties or interest or all of that. So the first thing, as I said, for federal taxes, the federal tax returns. Every company that's registered in the US has to file their tax returns. Now, if you have income in the US, or if you have employees in the US, in addition to filing the returns, you also have to then pay the corporate income taxes. But if you don't, then you just file the tax returns. And the returns are filed with the IRS, that's the Internal Revenue Service. The second federal filing that companies need to be aware of is the beneficial ownership information reporting. So the beneficial ownership reporting is another requirement that applies to every company that's registered in the US. It was introduced from January of last year. And the major reason that it exists is because the government is trying to prevent bad actors in the system, trying to prevent people from setting up shell companies and using them for illegal activities. So what the beneficial ownership information essentially means is that as a company, you are required to disclose the people who own significant shares in the company or who have significant control over the company. And anyone who has at least 25% of shares directly or indirectly in the company is qualified as a beneficial owner. The government wants to know who the beneficial owners of the company are so that if anything happens, they have actual individuals that they can hold on to that would be liable if the company breaks any laws or is carrying out any activities illegally. And this is very important because generally when setting up a company in the US, states like Delaware have a privacy focused structure in that on the surface, it's not easy to know who owns a company. So if you want to register a company today, for instance, you can register the company and your information will not be publicly available. If someone searches the company, they can see that the company is registered, but they just will not know who owns the company or who are the individuals behind the company. So this is that's what the beneficial ownership tries to deal with. So there's been a lot of back and forth with this particular filing because it's been in court. People have been contesting whether or not they need to make the filing. But the latest news from the government is that companies have until the 21st of March to file this report. So any company that is already in existence and hasn't done it has to do it before the 21st of March this year. So that's in terms of federal filings. Now for state filings, the state filings would depend on whichever state your company is actually registered in. Some states have income taxes that you need to pay. Some states don't. Delaware is one of those states that doesn't have any income tax requirement. However, Delaware has a franchise tax requirement. The franchise tax requirement essentially is a requirement for every company registered in Delaware. Again, we have clients who come and ask, okay, but I'm not making any revenue. I haven't generated any income. I haven't used the company. I don't even use it in Delaware. Do I need to pay this tax? Simple answer, yes, you do. Because the company is registered there, that's an annual fee that you have to pay to keep the company registered for the state to recognize that this company is registered and active in Delaware. The fee for the franchise tax differs between what kind of company it is. So if you're a corporation, actually the deadline for corporations just passed a couple of days ago. That was March 1st. And then there's a particular tax. If you are registered as an LLC, that's a limited liability company, the deadline is in June, so 1st of June, and you have until then to pay that tax. Beyond the state taxes, you also have a registered agent fee. So even if you're not physically present in Delaware, you are legally required to maintain a physical address in the state that can be used for correspondence. Delaware is one of those states where the state sends you physical notices for anything that relates to your company. They would send a physical document to a particular location. And then, so having a registered agent in that state makes it easy for you to receive those documents and for them to have it mailed to you. So you need to maintain that. And then there's also a fee. It depends on whoever your registered agent is. Different agents charge different fees to maintain your company in the state. And these are essentially just some of the major things that as a company registered in the US you need to be aware of. So and all of this just to say that it's not just okay to just register a company. You need to be aware of the things that you would be getting into. You need to be aware of the obligations that will be required of you by law so that you know if you want to register a company and you're not making revenue yet, this is one thing to consider so that you can calculate how much financial commitment would it require me to maintain this company before the revenue starts coming in or before investments start coming in. I know that our time is fast spent, so I'm just going to stop here so that we can take questions, and anything that I haven't already covered, I can answer during the question and answer session. Thank you so much.
Thank you so much, Uduak. That was a great one. And thank you so much So before we go into our question and answer, HealthCap as a company is happy to connect any of the participants with all these our guest speakers. So both from Bedavo and Legatron. So the immediate past speaker now is from Legatron. So if you have a company you want to register in the US, so we are happy to connect you to Woodward, who will then take all of these nuances away from you, while you focus mainly on operating activities and how to grow the company. So same as Pedabo. So any of the attendee that want to audit their book, as we have said, as we have highlighted, the purpose, the the gains abound from you auditing your company. So we are also happy to connect you. So before we open the floor for people to ask questions directly, I think your mics are even muted. So if you have any question, you can just put it down in the chat box. So I will read them. Anyone that relates to me, I will answer, and anyone that is particularly directed to some of our speakers, they will answer them to our satisfaction. So let me go to the chat box. Oh, wow. Okay. Okay, so yeah. Okay. So I think our questions start from here. So the first question we have here, as a lean startup co-founder and CEO, with my other co-founder being a CTO, Chief Technology Officer, with both of us having little knowledge on financials, is there a corrected software tool that can make handling the financials of our startup easy and simplified? If yes, can you share a specific software that can be useful to help my startup monitor our financials and position us favorably to raise capital from venture capital such as HealthCap Africa? Wow. We're also happy to support. However, to answer your question, yes, you said you are a lean startup company. So the softwares we have, many of them that are very, very affordable. So the likes of ZoboBook, very affordable. The likes of QuickBooks, they are very affordable. However, just like we mentioned during our presentation, if you can't afford that yet, probably I understand from the word CTO, I understand this is a technology-driven company. Probably you are still even building your software or your product. You have not even, you started operation, but you have not yet launched your software or your application or whatever you want to leverage on for your service, which means you may not have even started any revenue. So what then can you do? You can't even afford to probably buy some of the software. Yes, we also said that you can be keeping your record in Excel. You can be, we believe that Excel is basic. You just you spend something today, you put it down in Excel. You can even use paper and pencil, because at that period, we believe that your information, your financial information is not yet bulky. So you then have that. However, we also encourage that if you are doing that yourself, if it is just two of you alone, so if you are doing that yourself, like you are keeping the record, you just have a notebook or your Excel where you put it down that, okay, oh, just today, we bought laptop 1 million naira from so. So when you have those detailed information, you can then engage a financial expert, an accountant at the year end, for them to put all of these things together for you in form of financial statements. You just engage them. Maybe you don't have the money to have them in-house yet. You can just engage them and then have them put all of these things together for you. So I think in that, with that, you'll be able to have your financial statement prepared in line with the accounting standards. And of course, like we also said, you can also even go for small audit firm as well, who will charge you just little amount because your operation is not yet bulky. So just to ensure that they give comfort, that level of comfort that we discuss to that information. By that, you'll be able to manage your cost. At the same time, you'll be able to have audited financial statement, which, like, to connect it to your to the second leg of the question, which will then be useful for you when you want to raise your capital with HealthCap or any other venture capital frame, because we need to check your financial statement. We need to be sure that, and of course, aside your financial statement, we check your outlook, what your outlook is like, what your business model is, and every other thing that we need to check. But your financial statement is even the starting point, which you can play with. So you can just leverage some of those things that I've spoken about. So, like I said, if you have any question, put them down in the chat box. We pick them, and then the respective speaker will answer them. For a startup registered in the US but not yet functional, not making revenues, how does such a company handle cost that comes with tax filing? I think this question will be directed to Uduak. So just help us, just enlighten us on this question, just to expand more on what you have discussed earlier. Thank you.
All right, thank you so much for that. So to answer I would answer the second part of the question before the first part. So for the second part of the question, can such a company post the filings? Unfortunately, no. The answer to that question is no. You can't really post. I know that some certain jurisdictions have that kind of option, but for the US, there's no clear way to post a company. So what happens is, if you haven't paid, for example, if you haven't paid your taxes in about 2 years, the company goes into a void status. What that means is the state assumes that the company is no longer active or it's no longer in operation, and they kind of dissolve it. So by the time they dissolve it, you no longer incur any cost, any taxes after that period. But if you want to come back to use the company again, you have to revive the company and then pay whatever taxes you were owing. So you would still pay the taxes. There's no definite way to avoid paying the taxes. And then in terms of how to handle those costs, so there are, so for the state taxes, there's a flat rate, and then for LLCs, that's about $300, and then for corporations, that's about $450. So that's a flat rate. There's no, it can't be lesser than that. For the federal taxes, even if you don't have, if you're not making revenues yet, you won't need to pay taxes, but you will still need to file the tax returns, and then the tax returns need to be prepared by a qualified accountant, a qualified professional to handle those things. So now the fees for that will depend on who your tax professional is. Just like we heard on the call that we have different tiers for, say, Nigerian tax filers, there's a tier 1, tier 2, tier 3 companies. The fees for the US side is also something like that. So the different services that you see would also have different range. So you can just try to find one that is within your price range. Yeah. So that's basically it.
Oh, thank you so much, Udak. So we hope that answers the question perfectly for the questioner. Thank you. So the next question here, because if we must take all the questions, right? So the person is asking, do you also help attendee get remote job? We don't know the kind of remote job that the attendee is looking for, right? However, so there are a lot of sites where you can get remote job from. So while this webinar is actually is focusing on taxation, audit, and accounting, as it were, as it relates to startup. So we don't know the context to this question. Sorry. So the next thing on the chat box, yeah, just like I mentioned, this person is just corroborating what I said earlier, that Zoho Books, as a matter of fact, has a kind of free mode, trial mode that you can use to keep your record. So you can leverage on for the first questioner. So you can leverage on that to keep your record to ensure that you have accurate bookkeeping. So the next question: if a startup doesn't have any employees yet, but as part-time team member, should the startup still pay employee tax? I think I will just direct this question to Adeyemi to speak on. So this question is just asking if a company is still doing a kind of contract base, which type of taxes should they charge, or should they not even charge taxes at all? Just help us, enlighten the audience. Thank you.
Okay, thank you. So again, as incorporated is running, executing a contract or doing more like part-time or hard work job, as long as it does not meet that threshold, for currently now, it simply means if your turnover per year is not up to 25 million, you do not necessarily have to pay any taxes yet until your threshold increases. And even when the bill comes to play, it simply means that except that your contract is more than 50 million. So because you're doing a job on a contract basis, it does not actually exclude you from having to pay your taxes if you meet that threshold. I don't know if that answers your question.
Yeah, thank you, Adeyemi. So that really captures the question. It answers the question. So for the question, basically, because Adeyemi spoke earlier on that with the new tax bill that is being proposed, the small company will not now have to pay taxes, even VAT as well. So, and if you are doing contract based for your employees are also like your contractor. So because we believe that you don't hold on to them as your employees in that regard, because you are doing contract based. If their contract is not up to 15 million, just like Adeyemi said, that means you are not going to be paying taxes on them. So if that is correct, Adeyemi, did I give context to it perfectly?
Yes, you did. Yes, you did. Yes, you did.
Thank you so much.
You know, there's also a general notion that makes it look like if you have employees and they're on contract basis, you do not have tax obligation even for them. Yes, you do, except those people are exempted in their own capacity. So even when you get a contract staff to execute something for you, as long as the person does not earn minimum wage, that person will still be liable to tax. Just an addition. Thank you.
Okay, thank you so much. Okay, so the next question. So the next question, my question is with regard to beneficial owners. Must beneficial owner be a shareholder? Does the law contemplate a situation where beneficial owners are not shareholders? I know of instances where the owner and decision maker is not listed as a shareholder, hence my question. Udwak, I don't know if you would like to help us answer this question as it relates to company registration and the likes.
Yeah, happy to take this. So the beneficial owner does not necessarily have to be a shareholder. So the actual definition of the beneficial owner is anyone who has significant control over the company. So even if on paper they're not the ones who own the shares of the company, as far as they have control over the company, it's the information that is required. So for example, there are people who maybe register a company and then one company owns major shares in another company. So on paper, it's the company that is the shareholder, but when filling the beneficial ownership information reporting, the information that is required is information of individuals. That's information of actual people, human beings, not just legal personalities like companies. So it is the person that is behind the company that owns the major shares that's the person whose information is required. So as far as a person has significant control over a company, that person is the beneficial owner, even if they are not actual shareholders in the company. I hope that answers the question.
Yeah, thank you so much, Udak, for that. So let's take the next question. Our time is fast spent, so let's just quickly run through some of the questions here. Anyone we are not able to touch, we hope that like I said earlier, so we are glad to connect any founder, any business owner here, or anybody to either Pedabo or Udwak representing Legal Trunk. So the next question says, okay, should a founder pay employer tax even when he's not yet on salary? So this question, I don't know what you mean by employer tax, but if you mean that if a founder is getting salary from the company he has founded, should he be paying tax on himself, or should a founder pay employer tax? When the question is actually not clear, but we can just speak to, we can just think around how or what you intended, right? So if you meant that an employer who has founded a company who is not yet on salary but paying other staff, like we highlighted earlier, if you are contracting them on contract basis, so the initial answer that we gave to the first question will suffice, right? Meaning that whatever tax you will charge on them will be based on the amount of their on their contract. But if you are having them as a full-time employee, then you then need to charge payee on them and every other deduction, especially if you have more than I can't remember if it is 15 for pension. So there is a minimum staff that you must have, that you should have before you start deducting pension. But if you have it without before reaching that limit, it is still good, all good. So all well and good. So but for tax, like you charge payee on them, on their salary, and remit to the government. But if you mean on yourself as the founder, when you are not yet on salary, you don't charge payee on anything you don't earn, but you charge payee if you earn from other sources. If you are a founder that is just building your company alongside your normal job, of course, you earn from other sources. So you need to charge tax, you need to pay tax on the other sources. So if that's the question, so that's the answer to your question. So the next question, times subscription can paid in Naira also driven. So this is also corroborating the response we gave to the software, accounting software. So someone is also suggesting times, if I got the pronunciation correctly. So they said it's even you can pay for it in Naira and it's AI automated. So should a startup making below 5 million pay monthly VAT? Before I direct this question to Adeyemi, right, we need to take note of one thing. So the bill that Adeyemi spoke about, don't forget that they've not been passed into law. They are still being debated by the two houses. I mean, the House of Representatives and House of and Senate. So so that anything we speak on about the tax bill, we cannot apply them immediately. We need to wait until it is passed into law, so that we don't mix it. So I will leave Adeyemi to answer this question. I just want him to tell us what is applicable now and what will be applicable when the new tax bill is passed into law. So Adeyemi, you have the floor. Thank you.
Adedeji, could you please recap? I think my network missed out on that question.
Okay, the question is, should a startup making below 5 million, I believe that's revenue, pay monthly VAT?
Oh, okay. Not applicable. So where you're still a startup company, right? And your turnover does not meet 25 million currently, you do not have to file any VAT returns. The obligation for any invoice that you send as a company is on whoever you're sending it to, except that person is also a fellow small company. But when that person is a big company, that person will be held liable. There's something we call reverse VAT charge in the taxation terrain. It simply means that when you receive an invoice that does not have VAT, you as the company receiving or paying that invoice needs to self-charge. So what that has done is that rather than asking small companies that have less than 25 million to start charging VAT on their invoices, some of them are not even accessible at the end of the day anyway because of their business structure. So they would rather put the obligations on bigger companies so that I can hold a company to say, Soso Enterprises or Soso Limited sent you an invoice and didn't put VAT. Of course, the company will explain is a small company, or even if they don't have no explanation, that big company would now be held liable to say, okay, when that person did not put VAT, why did you not include it as part of your own cost? So to answer your question, as long as your turnover is less than 25 million every year currently, you would not be a VATable, you are not a VATable person. Even with the Nigerian Tax Bill that is going to come into effect, it simply means for VAT to be applicable, you now need to meet that 50 million threshold. If not, whatever invoice you send is not subject to the provisions of the VAT Act. Thank you.
Okay, thank you so much, Adeyemi. So the next question here, wow, people have a lot of questions, which is good. It speaks volume about the attention during the presentation. So the next question, of course, some other people are corroborating the fact that early startup can they can leverage on ZoboBook. So which means ZoboBook is winning. So which means any startup you can actually go for ZoboBook or any other one, any other software of your choice. So the next question is, how can we access the document to understand the VAT goods and services? So again, I will let Adeyemi answer this. If Pedabo has any resources that they can access, to understand more the vatable goods and services and non-vatable goods and services, as it were. Thank you. Adeyemi?
Yeah, hi, Adedeji.
Yeah, did you get the next question?
No, I did not. I'm actually having network issues here.
Oh, sorry.
I can hear you now.
Oh, okay, the question is, the questioner is asking that, is there any document that they can access, for them to understand the list of, or for them to have the list of vatable goods and services and non-vatable goods and services? I was now like, okay, if Pedabo has a kind of newsletter or any information on that they can leverage on.
Okay, of course. Such people should just send email addresses, send their email addresses, and we'll send them a document, something that they can quickly glance through.
Oh, okay. Thank you so much. Yeah. So great.
Welcome.
So anyone who is interested in having those documents can drop their email address. So why the document is shared with them after the webinar. So I think we will just take a few more questions and end this by 4:45. The time is, we are even, we are above the schedule already. So they said, what benefit would a startup forensic accounting firm in Nigeria get? And also, what should be its selling point if it wishes to get global partnership? I mean, Verma Forensic and Chartered Accountant is a new firm in Lagos. How easy does it get? I think, let's have Peter answer this question for us. Peter, please help us address this question. Hi, Peter. We just take 2 or 3 more questions before we go. Hello, Peter. I'm not sure if Peter is still there. Maybe Peter is having network challenge. I don't know. Peter, can you hear us? Okay, so hopefully if Peter comes back on board, we can just have him answer the question. So I think with the issue of taxes for contractor, it is great to highlight withholding taxes, but also to state that there is an obligation if the contractor does not have a tax number. If there is no tax number, what should be deducted?
Sorry,
okay.
Adedeji. My system was hanging. Apologies about that. Okay, he was talking about benefit for a firm. That what benefit?
Forensic accounting firm.
Okay, and I'm not sure what he meant by. Sorry, could you come again with the question?
What benefit would a startup forensic accounting firm in Nigeria get? And also, what should be its selling point if it wishes to get global partnership?
Well, again, in terms of selling point, it's important the firm does the right things in terms of ensuring that it's in compliance with most of the regulations and be committed to getting that global recognitions and meet most of the requirements. Again, interestingly, 2 years ago, Pedable committed to joining a network which is called Creston, and it came with a couple of requirements in terms of ensuring that our accounts, we have audited financial statements, in terms that the kind of clients we receive, the kind of due diligence we do on our clients. As a professional firm, you don't accept every single client you see. Basically, you have to do a due diligence, just like the bankers do, where they do the KYC, to ensure that you don't have a client that can bring your firm's reputation to disrepute. So it's important that as a firm that you have those proper structures in place. So I would say that one of the strongest points or selling points you can have as a firm is to say that you have the proper structures, in terms of saying that, for instance, getting a new client, you do a KYC, you follow all the audit requirements, you are compliant, you have all the necessary registration, you have the FRCN registration, the ICANN registration, you have all the necessary registrations. So if you have all this, I think it's easy to attract global partnership and also make it a selling point, especially when you go out there to market your firm. You are basically telling people that you are a firm where you've complied with all the necessary regulation, you've registered with Auditor General's office and all that, and that gives you a lot of leverage. Thank you.
Thank you so much, Peter. Thank you so much. That was a great response. So that question will actually be our last question for this webinar. But like I said, my HealthCap, also Pedable and Legatron, all these three companies are represented. So we are open to any follow-on question that you may have, and of course, if you want to engage Pedable, so you can also reach out to them. And if you also want to engage Legatron for all of your registration, and compliance issue. So because obviously we cannot exhaust all the question, we cannot answer all the question on this call, because we always have questions. So, and that is why we need to get in touch with the experts and relate all our questions and all our headaches, quote unquote, with them. Let them take the headaches out for you while you focus on operating activities and how you grow your company, like I said earlier. So this will bring us to the end of the webinar. We thank everyone for making it to this webinar, and special appreciation goes to all of our speakers. We really appreciate your time, making up time to join amidst all your busy schedules. So we thank all the attendees. We really we value your attendance. Thank you so much, and we are happy to get to receive follow-up questions from you. Thank you so much. Thank you.